Taxes can quietly erode your investment returns, but there are new tools like direct indexing that are helping investors fight back. So what is direct indexing and how can it improve after-tax outcomes? We're going to talk about that and break it all down for you right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thanks so much for joining us today. I've got Brian Smith from Eaton Vance joining me here in the studio. We've got a lot to get to. So, Brian, first of all, welcome to you. Good to have you here.
Thank you so much for having me.
Great. So, obviously, there's a couple of guarantees in life, taxes being one of them. We all have to pay taxes. We all have to deal with taxes every year, every day. Talk about the sort of the consequences and towards investors and why taxes matter so much, especially for those that maybe aren't as involved in their day-to-day investing, and how that plays into the success or the returns in a portfolio.
Yeah, I think your opening kind of framed it. Taxes can silently erode returns, and many investors, or most investors, are holding part of their wealth within taxable portfolios. And so we think about all of the different things that can create what I refer to as tax friction. So that is turnover of any kind. Even things that are prudent, you're doing the right thing within your asset allocation, such as rebalancing. Moving assets from one asset class to another and making sure that you stay within the right risk parameters, that turnover means that you're selling some of your winners and reallocating to some of your losers. That means that you're creating tax friction, you're realizing gains. And so as we think about what that can do to a client portfolio over long periods of time, as this erosion takes place, even though it seems incremental in the moment, it adds up.
Sure.
Any dollar that you take off the table and you ship it off to the IRS, that's a dollar that you don't have as a productive part of your portfolio. So if you can alleviate that even incrementally, you've created this compounding engine where you can put a lot more wealth in a client's pocket over time.
Right.
And so even just looking at this slide here, this would be if you could invest in the S&P 500 frictionless in a world with no taxes. And if you see like the average return of the S&P 500 over a 20-year period, $1 million would grow to about 3.8 million. If you then bring this portfolio into the real world with taxes, if you were to put a 1% tax drag or even a 2% tax drag on that same investment mandate, the amount that you have over 20 years is substantially stunted.
Right. I mean, over decades, it could cost hundreds of thousands, if not millions, depending on how much your investment is, towards your bottom line. So, right. So obviously, we're here to kind of talk to our viewers about ways to maybe try and avoid some of those tax consequences, and we talk about direct indexing. So let's get into what it is and how it applies to this tax conversation, direct indexing itself.
Yeah. So direct indexing is basically a passive form of investing. So many folks are incorporating passive management into their asset allocation in one way or another. That might be large cap through something like the S&P 500, but it really can go anywhere. You could passively orient towards large, mid, small, developed international, emerging markets. You pick a benchmark, and there's been different ways that folks have gone about incorporating that into their portfolios historically. Index mutual funds have been around for a really long time. And then we saw this incredible proliferation into ETF utilization. Direct indexing, think of it as basically the next frontier in indexing. Rather than going with one of those commingled structures like a mutual fund or an ETF where you're investing alongside other folks, what direct indexing is a separately managed account. You own the underlying holdings directly. So we're building an index using the component parts by the individual securities. Now that opens up the door to two things. One is systematic tax management. The market, regardless of which market you're looking at, there is systemic volatility that gets experienced, meaning that individual securities are not necessarily having the same experience as the market as a whole. Someone's having a bad day, whether that's a sector, an industry, or an individual security. If it falls below its cost basis, you have the ability to actually tax loss harvest it. And tax loss harvesting is an incredibly powerful tool that leads to your ability to defer payments to the IRS. So when you have a loss, it actually has economic value to you as an investor. The other thing that direct indexing opens the door to is customization. Rather than going and buying something off the shelf, you could ask us to customly construct an exposure. So I want the S&P 500, but don't buy my employer stock, or don't buy fossil fuel, or don't buy companies that are involved in XYZ type of engagements. So it allows for you to really tailor exposure specifically to the investor.
Right. My producer Kyle loves a metaphor, and so I told him that I was going to say to you today, because I thought about this, I've thought about, obviously SMAs are a huge part of our business here at UBS and with our partners like you all, but it's like going to the grocery store. You can either buy the prepared meal in the freezer case or the fresh food case as it is. Or you can buy all of the individual ingredients to make that meal, but say you don't like cilantro, you can leave that out. But you like a little spice, you can add a little extra Tabasco sauce and customize it to the way that you want that to end up being on your plate. So if that makes sense, and that's sort of a way to kind of put it in layman's terms for those who are like, oh, okay, I see. Totally customizable, working with your financial advisor to make sure it has what you want in there. And you can buy and sell out to avoid some of those tax consequences.
I think it's the perfect analogy. I might even add in with a personal chef, because you don't have to do the cooking.
Good. I like that.
When you buy the prepared meal because of the ease of use. This doesn't add any complexity. You're not necessarily sacrificing anything. Your expectation for returns is almost identical. You're just getting the tailored exposure where you selected the ingredients.
Right.
So I do love that analogy.
Great, I'm glad. And I think Kyle will like it as well. So let's talk about the after-tax outcomes for those investors who are utilizing direct indexing SMAs in their portfolios.
Yeah. So let's maybe dig into that concept of tax loss harvesting a little bit more, because what I found is the word loss can sometimes cause a visceral reaction for folks. They hear like the word loss, did I lose money? So the markets are having this noise all the time. It doesn't matter what benchmark we're looking at. It doesn't matter over what time period you're looking at. There are some securities within like using the S&P 500 as an example. Some securities are going to cross below their cost basis and be held at a loss. What parametric can do, or what direct indexing can do, is we can look at that security. When it crosses below its cost basis, we can sell out of it. That means that a loss carries over to your 1099 at the end of the year. With the proceeds from that sale, we identify a risk equivalent replacement. So we find something that has a like-kind exposure that contributes to the risk characteristics of the benchmark in the same way, so that your expectations for performance do not change. You still have expectations of mimicking that benchmark on a go-forward basis. But now that I have a loss that has carried over to my 1099, I can offset gains elsewhere. So, in that example I mentioned at the beginning, if you're rebalancing your portfolio and you need to trim down small cap because you need to allocate more to developed international, so the portfolio is adjusting. If within your direct indexing account, you're tax loss harvesting, you can basically match your gains and losses, net them when you go to file, and you should owe less to the IRS. You kept more money at work by simply just incorporating opportunistic tax management.
Right. I remember during the great financial crisis, I was working at a firm whose stock price went from 60 to about $1, and I was stuck in stock options. I couldn't do anything with them, but I remember freaking out, and my advisor said to me at the time, don't worry. We're going to take all those losses, we're going to leave them in your portfolio, and we're going to offset any gains you might get in the future, which I was lucky. You're lucky to get any gains at all sometimes in the markets. But I remember freaking out on the word loss, because that was a really good example that you gave. But losses can actually help you out when it comes to your tax consequences if you're getting gains later on in your portfolio. So I'm glad you walked us through that, Brian. Last thing is, let's talk about the type of investor that direct indexing is a good fit for. Because maybe, obviously, there's always risk. Doesn't mean you're always going to make money. It doesn't mean you're always going to offset those taxes. So there's like obviously risks in investing in any product or kind of a vehicle. Talk about those that it's good for.
Yeah, I'd say most folks can probably benefit from incorporating direct indexing somewhere into their total portfolio. Anyone who is paying taxes. So it's not going to be a great fit for a retirement account, but within a taxable portfolio, there's a bunch of different ways that we're seeing folks adopt direct indexing. One is, I would almost refer to it as a core satellite approach. Plug direct indexing in for something like large cap. So I'm sure no one would be surprised to hear that S&P 500 is the #1 benchmark folks are asking us to replicate. So have that as the centerpiece, and then satellite around it with active management or other investments like alternative investments that are just less tax sensitive. They're higher conviction, higher turnover, and that's okay. That doesn't make them bad, they're a great complement for direct indexing. So then other folks might say, well, I've got a large cap manager that I like. So this would almost be the inverse, satellite direct indexing. Choose it for something like small cap, mid cap, developed international, a different asset class within your broader asset allocation. Another application that we're seeing very frequently is for money in motion. If you have a collection of securities today, whether that is an existing separately managed account manager, maybe a self-directed portfolio, and you would like to migrate that exposure and say, I don't want that anymore, I'd rather just index this exposure. Parametric or direct indexing providers can transition what you own really tax efficiently and migrate you to look more like the benchmark over time. So rather than ripping the Band-Aid off and taking a whole bunch of turnover in your account, we can be really tax sensitive during your onboarding process. Again, in that theme of tax deferral, if you can kick the can down the road and be really sensitive about turnover, it keeps more money in your pocket. And then maybe the last one that I'll mention is around customization. We see a lot of folks that come to us and say, I work for a publicly traded company. One, maybe I want to start unwinding that, so I'm looking for tax coupons as I'm starting my sell strategy. Or I'd like to build a completion portfolio and contemplate the risk of my employer stock in this direct indexing account. Or maybe it's something more values-based, some sort of passion that you'd like to incorporate and see reflected within your portfolio.
Excellent, Brian, thank you. Yeah, it's great to have these conversations because I think maybe there are some folks out there who don't know that there are opportunities or options for them to think about a different way to invest in their portfolio. Obviously working with, like you said, that chef that's going to come to the house to put those ingredients together, AKA their financial advisor, to help walk through what's appropriate for their portfolio. So Brian, thanks for walking us through. Good to see you.
Oh, thank you for having me.
Great, thank you very much. Brian Smith from Eaton Vance, and thank you all for joining us. There's a lot more information on everything coming from UBS and our great partners like Eaton Vance at our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, the studio has its own dedicated Instagram channel. Follow us at UBS Trending. Lots of content there for you. And as always, as we mentioned, please make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon. Thanks.